Yo, what is going on, everybody? Welcome to episode 2 of the Nick Graves Trades Bootcamp. Today, this is going to be more of a beginner-friendly video, but I'm just going to be going over the main confluences that I use to enter trades, and the main PD arrays that I use every single day in the market, day in and day out, that have turned $100,000 into my bank account in the last 3 months. So, starting off, I hope you guys enjoyed the last video. Again, this is going to be a 14-day series. Basically going over everything that has turned me profitable, and everything that is going to be some free sauce for each and every single one of you guys. And yeah, to start this video, I'm honestly just going to get right into it because there's no need to talk about anything else because it's more of a strategy induced video. And I'm going to talk about confluences, but PD arrays, what are they? PD arrays are basically one of two things in like the market. They're basically confluences for price to react to, basically. So confluences for price to react to, as in like specific PD arrays get hit or mitigated, then I am anticipating some sort of like reversal or reaction for my strategy, and or not even a reversal or reaction, just some sort of like entry model where I am able to basically use them to get an entry. And there's a lot of different forms of PD arrays, but I'm going to be going over a specific few. One, the good old fair value gap. Again, most of you probably already know what this is. If you do not, obviously, if you're beginner friendly, I'm going to teach you what it is and how to use it. I'm going to be very quick with it. It's very, very simple and self-explanatory. Next up, we have a CSD, or a change in the state of delivery. These are very, very important when using like reversals, especially if you're trying to like bottom and top tick or looking for like very, very precise or specific entries. Then CSD, or change in the state of delivery, is something that I really highly recommend using because of its value that it brings. And then lastly, the last main PD array that I use personally are order blocks. Order blocks are very, very key in using and understanding price delivery action arrays, right? And honestly, I'll just do one more just to kind of introduce it. It is going to be rejection blocks. And these are the bottom and the top ticking goats, right? As in rejection blocks. And obviously I'm gonna explain all 4 of these in these videos. I want to really focus on these first 3. That's why I kind of had this like separate. These are going to be like the main 3 focuses. And then I'll get into rejection blocks and kind of give you guys like some sort of like sneak peek into kind of how to use rejection blocks. But yeah, this is kind of what I'm going to go over in the video. Now let's dive straight into a fair value gap. So I guess the question is, for those of you that don't know, what is a fair value gap? Fair value gap is a 3 candlestick pattern where there is a gap in the middle where, oh my gosh, guys, I cannot type, where there is a gap in the middle where orders are waiting to be filled. Okay, excuse the typing, but a fair value gap is a 3 candlestick pattern where there's a gap in the middle where orders are waiting to be filled. As in, there's a 3 candlestick pattern where no wicks overlap. So I'll show you an example on the screen, but I'll draw it with it first. So say here's one candlestick right here. This is the first candlestick in the pattern. Boom. There's its bottom wick. And then let's say this is the next candlestick that opens up right here. Boom. There's no wick. So say there's like a little wick on here. And then the third candlestick opens up right here, right next to it. And there's no wick. This little space that is in between this bottom wick, and then since this has no wick, it's the top wick right here. That is the space. That is where orders are waiting to be filled. Why? Because there are no price coming back up. Price has not come back to this point. If you think about it, the bottom of this wick, let's say, if you look at the number 23292, all the way to the top of this wick, 267.25, price has never had a chance to come back and reverse to. So with fair value gaps, we anticipate price to come back, fill these orders, and then continue lower. And this is an example of a bearish PD array right here. Now, again, if we want to flip it and make it bullish, all I have to do is bring this down to here. I can delete this now. Bring this up to here, and then bring this up to here. Go like this. Boom. Now what do we have? This is a bullish one. Why is it a bullish one? because the wicks are not overlapping inside of the middle one. So boom, you see this wick right here, and then the wick above right here do not overlap. So this entire space, there's orders waiting to be filled. So what can we anticipate? Price to dump down, come into our fair value gap, and then continue higher, right? And then vice versa again with the bearish one. We want the price to come back up. Let's say like this is the bearish one, come back up and then go lower, right? That's literally as simple as the fair value gap and kit. So now what I'm going to do real quick with you guys is kind of point them out on the screen and kind of show you guys how to find them, because fair value gaps, you can use them in a lot of different ways. High time frame fair value gaps are very, very important. So just kind of starting right here. Example, we're on the hourly right now. Where are some fair value gaps? Boom, right here. Boink. There's a fair value gap. What can we expect? We can expect price to what? Come up, mitigate it, and then continue lower if price is truly bearish, right? Same thing. Where's another fair value gap? Let's go to the daily. Because I remember this week, what do we have? A daily fair value gap. Boom. Right here. What does price do? Price creates an imbalance. What can we expect it to do now? Come all the way up, fill it, and then continue lower. And this is what comes into high time frame and stuff like that. I'm going to get into that later, but daily fair value gaps are more likely going to hold. But these are fair value gaps. Again, we're just going over the basics. I'm not going in too much into strategy and how to use them. Next up, we have CSDs, or changing the state of deliveries, right? And these are very, very important because these are when understanding reversals and how to use them. What is the change of the state? Change of the state is the last up close candle before the next down close, or vice versa. So it's either the last up close candle before the next down close, or the next down close before the next up close. If the change in the state is bearish, it is the last up close candle before the down close candle. Basically, changes in states are opposites of what it really is. So if a change in the state is a bullish candle, that means it's technically used as a bearish confluence. If a change in the state is a bearish candle, then most likely it's going to be a bullish confluence because it's the last up close candle before a down close candle, vice versa. So let me show you guys some examples of CSTs and really how to use them. So like I said, CSTs are kind of used in a couple of ways. But right here we have a 4-hour change of the state right here. This is the last down close candle before an up close candle. This entire thing right here is the last up close candle before, or the last down close candle before an up close candle. This is a bullish CSD. Why? Because price broke above the wick. It closed above the wick. Again, with CSDs, I use the wick, not the body. As soon as this candle closed right here, this became a valid CSD. Okay, cool. What does it mean this is a valid CSD now? Now we draw a line over from the wick and we see how price reacts off it. Boom. Look how price reacts off of it right here. Oh my gosh, guys. And here's some sauce. What's inside of a CSD? Oh, I don't know. Just something like a fair value gap, 4 hours, something that I just taught you guys. Boom. Look how price reacts off of it. I mean, this is just an example of how useful these PD arrays are. I mean, like just in these first two PD arrays, a fair value gap and a CSD, look how price reacts. Hits perfect CE of the fair value gap and then pumps up 645 points. Like, guys, this stuff works, I promise. But normally I like to use CSDs for entries. So if I have like specific like reversal points I'm looking for, example, I remember 9:30 open, we swept these highs right here. Boom. This is the last kind of like up close candle. I use the bigger ones when right here, this one would not be relevant to me just because how small it is. So I'll kind of use both of them. So technically this is the CSD right here, this line, because why? This is way too small for me to actually like really care about it. So I technically use both of these right here. So why? This body, the body of the candle, is where you draw the line from. So you see how this works? Boom. Oh my gosh. What does price do? Come up. We mitigate the CSD. And also like we mitigate first presented as well right here. That's something important that I'll be talking to you guys as well. We close above it. We inverse it. But again, I will get into why first presented sometimes does that. We mitigate the CSD and then we continue lower again. And then vice versa. If you don't use this CSD, now we get a next CSD. we close below, and literally as soon as the CSD is made, you're able to enter. Like with changing the states, you don't have to wait for a retracement like this. With changing the states, you can just enter as soon as it is created. There is no need to wait for a retracement. So a lot of times, like if you have like a reversal area, so let's say like this is like some sort of like area of like reversal, like somewhere up here, right? We mitigate it, we're anticipating some sort of reversal. So boom, we get our reversal right here, we get the CSD with this candle closure below it. All you can do is enter. As soon as this bearish candle closes at 537, once this closes right here, you're able to enter and your stop goes at the high. That's as simple as that. You don't need to wait for a retracement into a CSD. As soon as it's formed, you enter with CSDs. Next up, we have order blocks. And in my opinion, order blocks and CSDs are somewhat the same. I like CSDs more. Order blocks are kind of used for like continuation models, or like high time frame like PD arrays. So like example of like a 4-hour order block. An order block is basically just where resting orders are, right? Again, make sure you guys are journaling every single thing that I'm talking to you guys about, because these are very, very important things that I want you guys to use. But example, so we're kind of like chopping around, price chops around. This entire thing right here is an order block right here. Why? Because it is the last up close candle before a down close candle. We close below it, but this is not like at the bottom or the top. So that's the difference between a CSD and an order block. A change in the state is at the bottom or the top of a reversal. That is where the reversal starts. That's why there's entry levels, guys. For those of you that understand confluences in ICT, it starts with the liquidity sweep, something that I'll get into next video, then the CSD, then the fair value gap, then the order block, and then it keeps going, right? So the order block is like a confluence that is in the middle of like a range, basically. So right here, this is your order block. Right here, this is a 4-hour order block. High time frame always holds more power. So this is a 4-hour order block. If I go down to the 15-minute, look what happens. Boom. Big order block. We come down, we close below it. What do? We retrace right here at 10 a.m. What do we retrace into the order block? Oh my goodness gracious. A 15-minute fair value gap. And look how price reacts off of that. Guys, like I promise, this stuff works. Like this is just small sample size of how I trade, but we mitigate a 4-hour order block right here with this candlestick. We mitigate a 4-hour fair value gap. We mitigate a 15-minute fair value gap. And by the way, mitigate means like it uses it, or like, yeah, uses it basically. And then when we continue lower. Okay, guys, like this stuff works. But again, these are just the basics. And then like an example of like a 1-minute order block, you want to use them more in like continuation trades, right? So if we're in a downtrend, right? So we come down, this is the last up close candle before a down close candle. This is like our order block right here. And then you can see kind of price comes up, wicks into it, respects it, continues lower, boom, lower. And then it's just like a continuous trend, from then on, right? And like, I mean, more examples are just like here, like another order block. What do? We come down, close below, wick into it, continue lower. So order blocks, like low time frame order blocks, I really just use for like continuation models. High time frame order blocks I use for like rebalancing prices or mitigation. Lastly, let's get into the good old rejection block. A lot of people don't really understand what a rejection block is, but a rejection block is, and I only use high time frame rejection blocks. In my opinion, low time frame rejection blocks are irrelevant to me, because of their lower probability. But a high time frame rejection block is where price mitigates a key level or sweeps liquidity and leaves a wick where orders are resting and have other confluences inside of the rejection block itself. Cool. Here is the title of the rejection block. Like I said, it is where price mitigates a key level or sweeps liquidity and leaves a wick where orders are resting and have other confluences inside of the rejection block itself. So example, let's go on the high time frame and kind of show you guys what a good rejection block is and what it makes. Okay. Example right here. What do we have? Again, if you guys don't know what liquidity is, I'll get into it, but this is an example of like a liquidity. What's inside of this? There's a 4-hour fair value gap. Boom, what does price do? Price mitigates it and sweeps liquidity. So this is our 4-hour rejection block now. So what do? We draw out this rejection block, only the wick of it. Look what happens. What is inside of a 4-hour rejection block? You have to think about it because time is fractal. In this 4-hour wick, this wick right here, This means that price reversed because there's a wick and the candle didn't close for another, how many points is this? For 170 points down. So that means there's 170 points of lower time frame price action that is being made, right? In this lower time frame price action, there are other PD arrays and confluences being created. So if I draw out this, what's going to be inside of this? Fair value gaps, order blocks, levels that are waiting to get some sort of like retested. So if we go to the 5-minute, look what we have here. Okay, we have an example. We have an order block, or sorry, a CSD right here, changing the state. This entire thing, price comes up, mitigates it, continue lower. Boom, that's on the 5-minute. What else do we have? We have a fair value gap. We have all the above. We go to the 1-minute. I'm still on this. Let me get off of this. Oops. Go over. Oh, 1 minute. Let me make sure I'm doing this right. Hold up. Sorry, guys. 23rd. Oh my gosh. Here we go. So now on the 1 minute, again, time is fractal. We have the same thing. But what do we have here, guys? We have an order block, a big 1 minute order block. On top of that, we have a 1 minute fair value gap. Once price comes back into the rejection block, it mitigates these PD arrays, right? And then we continue lower. We're creating these imbalances. Again, bearish fair value gap right here. What is a fair value gap? It's space in between this wick and this wick right here. Do not overlap. It's a 3 candlestick pattern. We continue lower off the rejection block, right? Like this type of stuff, like, promise guys, like this stuff works. It's no joke. But how you use rejection blocks is basically you understand the wick, you draw out the wick, and then you kind of anticipate it to hold. I mean, same thing here. Here's a big 1 hour wick. What happens? Price comes in, mitigates the PD arrays that are inside of it. Example here, you see this is the big wick, big CSD, and then we mitigate it, come higher. We get a change in the state right here. You get an entry, continue lower. All this type of price action. Again, these are just like the introductory to you guys. But do not think a rejection block is just a random wick. It has to sweep liquidity and mitigate some sort of like price display action. So you guys have to understand that when using rejection blocks. Again, that's kind of why I made it separate than CSCs, order blocks, and for value gaps. But I hope you guys enjoyed the second day of the bootcamp. I hope you guys are taking notes. Again, if things you found confusing, make sure to DM me on Discord. That's why I have this forum open, so you guys are able to comment any questions. I will answer them for you guys on the Discord. But yeah, make sure to like, comment, subscribe. Love you guys. Appreciate you guys. And I'll see you guys in the next video. Peace.